Hello everyone, welcome to our new video. This is the second part for chapter 3. So we were talking about the balance sheet of a company, and we have seen an example. In this example, we have the Allied's balance sheet, which has for 2013 and 14. And we have mentioned that on the balance sheet, we have the assets on one side of the balance sheet. And the assets we start to write from the most liquid towards the least liquid. So the most liquid assets on the balance sheet start from this item here, cash and equivalents. And then we continue with relatively less and less liquid assets such as accounts receivable. And then we have inventories. And then we sum the total current assets. So this is given as 1,000, but these are in millions of dollars. So this means $1 billion actually. And this is $810 million as of 2013. And then we have the next fixed assets. And as you know, the fixed assets are less liquid compared to these current assets. Fixed assets include plant and equipment, such as buildings or some fixed equipment of the corporation. And then there is the other assets that expected to last more than a year. And finally, all these items are added together. That gives us the total assets here for this example. And on the other side of the balance sheet, we have the liabilities and equity. And we have current liabilities. Again, these are starting from the most immediate, most short-term liabilities towards longer-term liabilities are listed on this side of the balance sheet. And as you see, we have the major category here as current liabilities, including accounts payable, accruals, notes payable. And usually this notes payable has interest-bearing property. So we have to also pay the interest for the notes payable. And then these are added together to calculate the total current liabilities of the corporation, given as $310 million. And then as you see, longer term liabilities are listed, such as long-term bonds, and that is given here. And then the total liabilities is calculated by summing these two. That gives us this number here. And then once the liabilities are completed, the next part is the equity. And we have the common equity that contains the common stock of the company. That these are the shares issued by the company. For example, this company has 50 million shares issued. And then retained earnings. Retained earnings contain the cumulative retained earnings that are obtained from the net profits of the company that are basically preserved within the company. And this is written cumulatively under the retained earnings item. And then this is added together. These two items are added together to obtain the total common equity here. And once the total liabilities and this total equity is added together, that gives us the total liabilities and equity item. If you pay attention, this is again same as the total assets here for 2014 and 13. Both of them are the same. So we have this accounting identity here. For example, again for this company, we can calculate the book value per share because we know that we have 50 million shares, and then we should calculate this. We should use this total common equity, which is given as 940 million. Both of them are denominated in millions, so the book value per share for this company is obtained as $18.80. There are some notes here. Preferred stock can take several different forms, but it is generally like that because preferred stock pays a fixed amount each year. However, it's like common stock because a failure to pay the preferred dividend doesn't expose the firm to bankruptcy. So this is also an important difference. And if a firm does use preferred stock, it is shown on the balance sheet between total debt and common stock. And there is no set rule on how preferred stock should be treated when financial ratios are calculated. It could be considered as debt or as equity. Actually, bondholders often think this as equity, and the stockholders think this as of debt because it has a fixed charge and preferred stock has the priority compared to the common equity holders. But debt holders, the bondholders, also has the priority compared to the preferred stockholders. So it is something in between and can be considered as a hybrid. There are some examples you can check for our Turkish stock market. We have actually the balance sheets of publicly listed corporations are basically given in this website. And there is some example also from another website that is investing.com, and they have also the Turkish version of the website. And as you see, I have used one of the largest corporations in the equity market, that is Ereğli Demir Çelik. And you can see for our market, in the Turkish markets, we can see that the first website link, they publish a summary, consolidated balance sheet, including this current assets, fixed assets, and all together this is listed. Basically, we have the current assets as dönen varlıklar, that is given here. And then we have the fixed assets, that is duran varlıklar, that's given by this number. And if you add these together, then we get the total assets for this company. And as we see, actually over the, this is 2020 and 2021 and so on. And this is as of June, because the year wasn't completed as when I collected this data. This was the latest balance sheet that is available, and we can see rapid increase in all these numbers. That's mainly because of the high inflation during this period. Okay, especially as you know from 2021, we have this significant inflationary effect in all these numbers. There's a rapid increase. And then we have the yükümlülükler, that means the liabilities. This is short-term liabilities, long-term liabilities, and then we have the total liabilities, and then we have this equity items, okay, like common stock, and then this is the total equity is given here. Okay, it's just an example for our domestic market. And this is another example of using the website investing.com. Again, it contains the total current assets are given. Okay, so that's the total current assets of the same company. But pay attention, these balance sheets are quarterly. Okay, these are the quarterly published balance sheets of this Ereğli Demir Çelik Corporation. So usually for these I mean, basically the rule is every quarter these publicly listed corporations, they must announce their balance sheets, income statements, and other financial statements. And that is available once it is published. And basically we can see the inventories here. And this has a bit more details than the previous balance sheet, which was the consolidated, basically it's like a summary table, because actually these are very large corporations and they have many items in their balance sheet. Usually it is presented in a summarized form for the investors. Basically these are the major categories you can see. If we click on these from this website, it will open up more sub items, but these are the major items, like total current assets, and then the total assets, and then there is the total current liabilities, and equity side. Okay, we have these items here. Again, for when we later on we will do more analysis like financial ratios for the corporations, and as an investor we will analyze these financial ratios and try to find useful information about these companies. And finally, of course, our goal might be to pick some stocks for investment. And in order to do this, we need to analyze the balance sheets or income statements and financial ratios that are calculated from these statements in order to get a good understanding of these companies and how they have been doing from past to current period. We have also cash versus other assets. Although assets are reported in dollar terms, of course, for the US market, but for the domestic market, we have the Turkish lira. Only the cash and equivalence account represents actual spendable money. So actually, this is the directly the money that we can directly spend right away, that is given under the cash and equivalence account. Whereas the accounts receivable represent, for example, credit sales that have not been collected yet. And on the other hand, we have, of course, the inventories. And this is also show the cost of raw materials or work in process and finished goods. Of course, these are already, again, they have value, I mean, monetary value. That is, for example, the company produced some goods that are available for sale. Although they are not sold yet, that can be in relatively short term, it can be converted to cash. And then we have the term that is defined here, that's working capital. So current assets are often called as working capital because these assets turn over and they are used in our operation of the corporation. They are used and then replaced throughout the year. Allied, for example, for the example company, we have so-called Allied buys inventory items on credit. Its suppliers, in effect, lend it the money used to finance the inventory items, because this purchase is done on credit, not immediate payment. So the corporations usually pay their suppliers with some intervals, not right away. So it becomes like a credit effectively. Here in this, we have some formulas that describes the net working capital is given by the difference of current assets from the current liabilities. So this difference gives us the net working capital. And on the current liabilities, we might have like accounts payable, accruals, and notes payable to the bank. And usually financial analysts make a distinction between the free liabilities and interest-bearing notes payable, as we said, which incur interest expense. That is included as a financing cost on the firm's income statement. So this financing cost item will show on the income statement. So with this distinction, the financial analysts often focus on net operating working capital, which differs from net working capital because these interest-bearing notes payable are subtracted from current liabilities. So in this new formula, net operating working capital, current assets still remain the same. We also have current liabilities, but the notes payable item is actually added to the previous total. So if we consider the previous one is 690 million, now we have added the interest-bearing notes payable to this net operating working capital. Here's a quick example from our reference textbook. In this one, basically looking to the given example, Allied's balance sheet. First, what's the net working capital as of 2013, end of 2013? So you just can check our table that we have seen and find out what's the current assets and minus the current liabilities. As we gave the formula, this gives us the net working capital as of 2013. So what about net operating working capital? Then the only difference will be now after calculating the net working capital, we are going to add this guy. This is minus plus sign. So effectively we are going to add this 60 million on top of this number here, and that gives us $650 million as the net operating working capital. Total debt versus total liabilities. A company's total debt includes both its short-term and long-term interest-bearing liabilities. So the total debt, as you see, will include both short-term and long-term. And total liabilities equal total debt plus the company's free liabilities. So that will, when we calculate the total liabilities, total debt will be included plus the free liabilities that doesn't bear any interest payments, because suppliers, for example, give us the raw materials and we pay them back after 1 month or after some time without interest. There is no interest charge for this type of liability. Allied's short-term debt is shown as notes payable on its balance sheet. So in our example, this is under the notes payable that gives us the short-term debt of the company. As you see, total debt equals to short-term debt plus long-term debt. For the example table, we calculate this as 860 million. What about the total liabilities? Total liabilities, as we have already seen, is given by the total debt plus accounts payable plus accruals, and that's equal to 1.06 billion in our example. Other sources of funds, most companies, including this Allied in our example, finance their assets with a combination of short-term debt and long-term debt and common equity. Actually, we will discuss the details of financing decisions by the companies later in our later chapters because it's very important for the company to decide whether they should issue debt, such as issuing the bond or using bank credit or they might consider to issue shares in an IPO. So they have different advantages or disadvantages, and depending on the macroeconomic outlook, usually companies will prefer one of them, or for diversification purposes, they might also use a combination of these financing tools. And some companies also use hybrid securities such as preferred stock, convertible bonds, and long-term leases. So these are also available for companies. The depreciation, most companies prepare two sets of financial statements. Actually, depending on the country and regulation, there might be some differences in these practices. But in the US, it is possible to prepare one financial statement for the IRS for the tax purposes, and another one can be prepared for the reporting for the investors. So that's also possible. And usually firms might prefer to use accelerated depreciation for tax purposes, but might use a straight line depreciation method for their balance sheets for the stockholders reporting. Another important difference exists for the market value versus the book values of corporations. And companies generally use the GAAP to determine the values reported on their balance sheets. In most cases, these accounting numbers are different from what the assets would sell if they were offered for sale. In other words, these book values and market values, they might often diverge significantly in the market conditions. There is also the time dimension that we should keep in mind. Another note, the balance sheet, remember, is a snapshot of the firm's financial position at a point in time. So this snapshot can, of course, change in many different ways over time. Okay, so let's stop this video here, and then in the next video we will talk about the income statement.